Law firm owners, you're probably here figuring out how much your law firm is worth. Well, Rich, what do we think?
Yeah, MPS, the bad news is their law firm isn't worth nearly as much as they think that it is, and it's probably not worth very much at all unless they take some steps we're about to lay out for them. Would you agree?
I would agree. So let's walk through what that looks like for them.
Yeah, so first and foremost, let's talk about the elephant in the room. So some law firm owners are thinking about exiting their firm. They're maybe in their late 40s, early 50s, maybe they're in their 60s, and they're thinking, well, how will I retire someday? Can I sell my firm? Can I succeed my firm to somebody else? What value will it have? Are there actually buyers out there? And look, we're not yet at the point, MPS, where there are non-attorney buyers all the way through the 50 United States that are going to purchase their firm. It's not there yet. Agreed?
Yes, but that key point being yet. So prepare your firm for when that comes, because at some point, whether short term or long term, it'll be here.
Yes. Now, whether you're going to hold your breath and wait for that to happen, or you're like, hey, Rich, I'm like 65 or 70 and I want to do this in the next 3 years, no problem. You can take what we're about to tell you and you can break down your firm piece by piece so you can understand how a buyer is going to look at it. So, by the way, why I have any right to do this is, this is now my 7th company. I've had massive failures. I've had massive successes as far as a small business owner is concerned. And I've had to go through the buying experience. Way back when, I read a book called How to Buy a Good Business at a Great Price by Richard Parker. And when MPS decided to buy this firm, Michael, you went through that process as well, correct?
Yeah, had to go through the same process, determine the value of this business, and figure out, as a new buyer, what would I do and step in to add value to the business quickly, and what could I do to remove risk from the business quickly.
Yeah, and I've had clients hire me at, ridiculous hourly rates to come into their firm and try to evaluate the value of their business because they wanted to sell or succeed their firm. And so we've done this time and time again with law firms. So let's get right into it. MPS, the first thing I have to talk about is revenue. Now, while revenue is not a pure indicator of what the owner makes, it is an indicator of growth and whether we're moving forward or we're moving backward. Would you agree?
Yeah, I mean, you got to start from your top line there and determine what that looks like at a high level. So you got to get really clear. And just to be clear, revenue, that's money your firm actually collected. Not necessarily gross sale value, but money your firm actually collected in that calendar year or in that set of years.
Yeah, that's so huge because that is either attractor or detractor. So let's talk about this concept of attractor and detractor. Michael, what is the difference between an attractor or a detractor, or an increaser mechanism or a decreasing mechanism?
Talk about like an adder, subtractor, attractor, detractor, however you want to refer to it. A value adder is going to add value to the business. It's going to enhance the value overall of the business. A subtractor is really what's a risk to the business. What's at risk that would detract from the value of the business and make it less appealing to a potential buyer. So if we're taking revenue at the top side and we're talking about value attractors and detractors, we also have to go all the way down to the bottom line, because that's what you realize, and that's called EBITDA. So Rich, let's define what is EBITDA.
All right, so let's spell it out. So it's EBITDA, earnings before interest, debt, taxes, and amortization. Right, so basically what we're saying here is that this is the amount of money that can be reinvested into the business. This is the amount of money that you, as the owner, can take something out of for your owner's benefit. This is the amount of money that you can use to pay your taxes from your owner's benefit. But this is like the investable portion back into the company. And when you look at EBITDA, you really want to be looking at a goal, MPS. By the way, we use the word owner's benefit. That's somewhat synonymous with EBITDA. It's a little bit different because it adds in a bunch of add backs that we can talk about. But generally speaking, we want to see a total owner's benefit for a firm sitting somewhere between 25 and 35%. Would you agree with that?
Yeah, I would agree with that, even upwards of 40% in some cases when we're ultimately efficient.
Yeah, look, truth be told, we have firms that we work with that are not just pure PI plays. They're fee-based firms that have real collections issues and all the other moving parts of an actual having to get paid kind of a firm that are earning 50, 60, 70% total owner's benefit numbers because they've just improved their overall efficiencies, which we'll talk about in just a second. Now, MPS, where do we go here from value adders?
Yeah, well, let's first make sure we're clear. So, EBITDA is going to kind of be your North Star metric for helping determine the value at the end of all of this, because at the end of the day, that's what you're actually keeping. So, first tip here for law firm owners is one of your first opportunities, increase margin, right? So, increase your EBITDA, keep more of your money down to the bottom line out of your revenue. So once we start from that understanding and you're maximizing profitability, now we can start to really look at value adders, value detractors.
Yeah, so I want to plus one on that real quick, MPS. So are you suggesting two fundamental things? That if their EBITDA goes up, that their possible multiple would go up? Is that true?
That is absolutely true. If you're able to
So,
keep, yeah.
well, what is a multiple? Just so, because I feel like we could lose them there. So what's a multiple?
Yeah, a multiple is basically a multiplier of your EBITDA. So you take your EBITDA times whatever multiple it is. And that could be one, it could be two, depending on when we get into value attractors or detractors, that will assign values to multiple. And then you times it. So you multiply it times that multiple. And that'll help you determine what the value is. I don't want to get too deep into the math for them because I don't want to lose them. But that's what the multiple is. So really what we're trying to figure out here through this whole equation is how do we make that multiple as big as possible?
Correct. And so your goal as a business owner is to try to get as much money to EBITDA. Oftentimes, as a business owner, your goal is to reduce your income so that you don't pay taxes on it, so you reduce your tax liability. When you're going to sell or succeed the firm and you're going to evaluate your firm, your goal is to maximize your EBITDA or your owner's benefit so you ultimately maximize the value of your firm. So depending on your goal, what you do with your firm will differ. So it's really important to know your goal, because if your goal is just to make a lot of income and not build what we call enterprise value, then you're going to keep as much of it in-house as you can, and you're going to like offset it with expenses or tax liability reduction tools in order to make your firm maybe not look as profitable so you don't pay the IRS quite so much. But if you're trying to get enterprise value, you are going to look to build that EBITDA and that owner's benefit as high as possible. Is that an accurate statement, MPS?
It is an accurate statement. So if we start with the two fundamental numbers of revenue and EBITDA, that'll give you your baseline. So we've got a baseline. Once you've got your baseline, now let's talk about what can attract value. So what can help you increase your multiple? And one of the things that can help you increase your multiple is you've got revenue, but what does revenue growth look like? So Rich, why don't we talk about that a little bit?
Yeah, so look, a business is moving forward or it's moving backward, but it's rarely standing still. And even if it is standing still, inflation alone is chewing up EBITDA. So if your growth revenue is $200,000 this year, $500,000 this year, whatever it is, and it's $500,000 the next year, and the next year, and the next year. So you might feel good about sustaining that. And by the way, congratulations of building a successful firm. And I'm hoping you're keeping, that 35 to 40% to the bottom line. But assuming that you are standing still, you're actually going down because inflation is chewing up your overall expenses by raising your expenses, fundamentally decreasing your EBITDA, fundamentally decreasing your value. So you want to see your firm moving in an upward trajectory of growth. That doesn't mean it has to grow at 30, 40, 50, 100%, but it does need to grow. Conversely, if your firm is going in the opposite direction and it's going downward, it brings up a lot of questions as to why that's going on, and that subsequently takes away value. So if your firm is going down or standing still, you don't gain any value, in which case you actually may lose some value. If your firm is moving upward, you'll actually gain value. Is that correct?
That is correct. So we got to define what that looks like. You need to calculate what your year-over-year growth looks like from a revenue perspective, and that'll help give you a marker. Once you get that percentage, there's some brackets it can fall within to determine what a multiple may look like, if at all, on that revenue growth. And as we're talking about attractors, once we determine what that number is, this one's usually a little bit more difficult for law firms because of the nature of a lot of them having fee-based firms and at one-time client. Most of you, depending on your practice area, may not want to have to see a client twice, right? But this idea of like yearly revenue retention, right?
Yeah, so there's something called recurring revenue and reoccurring revenue, right? So recurring revenue means you've got a business to business transactional firm and you serve a business year after year after year, and maybe they're worth $5, $6, $10, $12, $20, $30,000 a year to your firm because they continually give you work, and as long as you build a relationship, you don't lose that work as long as they're in business and continuing to need your services. That's recurring revenue. Reoccurring revenue is where you've got a bankruptcy firm and you generate 100 new cases a month, and out of those 100 new cases, one or two of them have a PI issue, and you bolt on a PI firm, whether it's through a referral-based system or you actually build your own firm, and you bring on those one or two PI cases every month as a natural referral source to your firm. That's reoccurring revenue, and you can do that with as many practice areas as you want. And so the more recurring revenue you have, or the more reoccurring revenue you have, the more valuable your firm becomes, because it shows that you have a relationship with your client base. They know, like, and trust you and see you as their legal source, thus providing the buyer with further security that they don't have to wake up broke every morning. They can rely on the relationships they've built through the years. Did I accurately summarize that, MPS?
You did, actually. I think you said that perfectly. And look, as we're talking through all of this, and you're trying to figure out and sit here and say, okay, I'm tracking with you, but I'm trying to figure out the value of my firm. We're obviously going to talk through it, but if you want to get laser guided focus on exactly what the value of your firm looks like today, you can go to thelawfirmsecret.com, and we're happy to kind of walk that through with you, so that way you could get some clarity on what that looks like. But I want to come back to this a little bit. So same thing here, depending on what that percentage is, it'll determine whether there's a multiplier or there's not a multiplier there. And then if we work down another layer to a value attractor, we start to run into EBITDA margin. So this is what we were talking about earlier, Rich, right? When we were talking about total owner's benefit being somewhere between 25 to 35, if not even higher, like 40, 45%. But this too is going to impact whether or not a multiple gets assigned. So Rich, did you want to break that down at all? I know we talked about it a little bit.
Yeah, so look, EBITDA margin is the percentage, which we were talking about earlier, right? So if you're not keeping enough to the bottom line, like, so top side revenue is for vanity, bottom side revenue is for sanity, but it's also for valuation. And so if you want to add value to your firm, you have to have a margin that's attractive to a buyer. Here's why. Oftentimes buyers are going to be buying with some level of debt, or they're going to use a cash infusion, in which case a higher margin gives them a higher cash-on-cash reoccurrence, or it allows them to recapture their cash so they can go use it to acquire another firm faster. And so they see a higher margin as the ability to be able to capture their cash faster. Also, it gives them a higher point of security that they know that they're not working with skinny margins. So if something negative were to happen in the business, the higher margin gives them the opportunity to be able to recover from any minor mistakes. So having a higher margin is not only good for you as a business owner, you get to keep more of it, but when you're creating value, or what we call enterprise value, you're going to need to make sure that the margins are higher, and if they are, you can command a higher level of multiple.
Yeah, and that segues really well, this idea of enterprise value and value, into the next part. I love this little equation here, which is, if we're talking about value attractors, one of the big ones you need to have an understanding of is LTV to CAC. And so to quickly define this, LTV is the lifetime value, or the lifetime gross profit of a client, and CAC is client acquisition cost. So how much does it cost you to acquire a client for your law firm? This is a very magic formula, and it's one that we should always figure out, how do we increase LTV and how do we decrease CAC? But Rich, why don't we talk a little bit about what this means?
Yeah, so listen, if you want to know more about LTV versus CAC, we're going to go deeper on this in another video. You want to go ahead and click on the link below in the description. We'll tell you about it. But suffice it to say, this idea of lifetime client value is the gross value of a client, which means it's what you sell the case for and how much you collect of it. So the actual collected money that you get for the case, minus what it costs you to put the case out the door. And depending on practice area and everything else, there's lots of different formulas. That gives you your lifetime client value of that particular case. Now, as I said, if you have recurring or reoccurring revenue, then you have multiple different matters with that particular client. Your lifetime client value will go up. So reoccurring business with a client actually makes your LTV go up. And then you have to look at CAC, cost to acquire a client, right? And so the cost to acquire a client really comes down to how much is it in marketing, agency costs, sales commissions, appointment setters, the whole 9 yards. And then you divide that by the number of new clients or new matters that you get, and that would give you your CAC, right? So you have your LTV and you have that divided by your CAC, and that gives you like a ratio. And a healthy ratio is that anything north of 3 to 5 is really solid. The great news about law firms is oftentimes you can get to an 8, 9, or 10 really easily. The great news is if you do this right, you can actually get that LTV to CAC ratio like to 20, 30, 40, even 50 times in a law firm setting. So the higher that LTV to CAC ratio is, the more valuable the firm is. Did I do that justice, MPS?
You did. It's one of the formulas I really enjoy. It's fun to figure out how to increase LTV and decrease CAC. Maybe it's because I'm a sales and marketing guy at heart. The next one's kind of an interesting paradox because the next one kind of sits in both the value attractor and detractor, and that is a systemized practice. So does your firm have systems or does it not? Because if your law firm has systems in place that a potential buyer could come in and already have established systems to depend on, well, it becomes much more attractive to that buyer. But on the flip side of that, if your firm's a mess, and although maybe you've got some of these other metrics in place, but you don't have systems in place for each department in the firm, and there's no clear path there, that can very much be looked at as a risk to that business, or obviously a risk seen as an opportunity for a potential buyer as well. So I don't want to just position it as only a risk, because a potential buyer may look at that and say that they could come in and flip that as an opportunity. But from a valuation perspective, it's a risk.
Yeah, so because they could do it. So if a buyer comes in and goes, oh, I got systems dialed in, I'm going to take their firm, fold it under my wing, and we're going to make it more valuable because of our systems. That's great news. But here's the thing, they don't pay you for that, right? They only pay you for what you've built. So they don't pay you for what they add to the table. They don't pay you for potential. They pay for what you've done. That's how valuations work. And so whether you're selling it to a sole proprietor, or you're passing it on to succeeding it to somebody in your firm, or you're selling it to an enterprise situation who's acquiring your firm, maybe in a roll-up scenario, or they just want to capture market value by purchasing your firm, the way that you make your firm more valuable is that systems should run your law firm and people should run your systems. And if right now your systems are a hot mess because they're all run by you or Sally in your office, and they're all in Sally's head, and she's the only one that knows how to make things happen around here, and we don't have systems that run our office, we have Sally that runs our office, right? And so it's really important to have the systemized office, and it takes step-by-step approach to get there, but the more systemized your office is, the more valuable it is. The less systemized your office is, the less valuable it is, because buyers don't pay for potential, they pay for what you did.
Correct. And that leads you to your last kind of value attractor in this sense for a law firm, which is when and if you decide you want to sell your law firm, are you willing to have more of a termed buyout? So you as the law firm owner hold the paper for someone that's coming in and buying the practice. Are they going to put a percentage down and you'll hold the note for the rest, and maybe even go through an earn-out period to phase out of the law firm? And we'll talk about what the inverse of that looks like on the detractor, but this is much more appealing to a potential buyer if they don't need to necessarily find the cash to just outright buy the practice with no transition period, with no favorable terms on their end. Would you agree with that, Rich?
Yeah, so let's go ahead and call out the elephant in the room, like that detractor. So you either are going to take a buyout or you're going to cash out, right? So if you're going to take a buyout, you can get a higher multiple. If you're going to take a cash out, you're going to get a lower multiple. So in one extreme, you say, hey, I'm done, I'm out, I've got everything dialed in, but I want to just cash out. And I don't want to be here. I don't want to be I've done all the things to reduce all the detractors or the valuations I can, and I just want to cash out. That's fine, but it's probably going to lower your ultimate valuation or your multiple because you're not sticking around to make the transition happen for a period of time. So the more you want to cash out, the lower your ultimate multiple. The other extreme of that is, hey, listen, you come in, buy my firm, don't give me a nickel at all. Don't pay me a nickel. But over time, you pay me X number of dollars based on a rev share of the revenue that comes in. So like that's the ultimate buyout, right? So you're like, you don't have to pay me anything. You're going to buy the company. You're on the hook for the company, but you're going to pay me in a rev share, which means I'm going to stick around and make sure you have all the institutional knowledge to make sure that this happens. So those are the two extremes. And so if you're a small firm, $200, $400, $500, $600, $800,000, $1 million, and you want to sell your firm, even arguably up to $2 or $3 million, quite frankly, until you're getting to like the $1, $2, $3, $4 million in EBITDA, I would say you're still in most people's eyes a small firm. So until you're at that, let's call it $3 million in EBITDA, the more you're willing to finance the deal, the better the multiple you're going to get. And the more you want to cash out and be done, the lower your multiple. So you got to think about that if you're exiting and you want to retire.
Right. And so that is your set of value attractors. That's how we're going to attract. And in some cases, we talked already about a few detractors. That's how you're going to attract more value for a higher multiple. But let's talk about the value detractors. What brings risk into a potential acquisition? And so the first and king of risks, in my opinion, for law firms is key man risk. So key man risk means everything starts with you, everything ends with you. If you stop, the business stops. And for many law firms, this is very much a reality, which is why if a potential buyer is looking at a law firm, a potential buyer is much more likely to go to a law firm that's got lots of staff, lots of systems, different attorneys running all of the legal work compared to going to buy a solo practitioner. Rich, would you agree with that?
Yeah, I 100% agree, MPS. I would bifurcate this for you, though. So there is maybe we can even put it to 3 levels. So first is marketing. The second is sales, and the third is operations. So let's start with operations. Like if you're the lawyer doing the work, many lawyers think like nobody else can do the work but me. That's a fallacy. We can find other lawyers to do your work. We know that because we help lawyers do it all the time. So that's one of the easiest places to get your key man risk out is to replace yourself as the lawyer. The second area, it's easiest to replace yourself as the salesperson. A lot of law firm owners think that they're the best salesperson and nobody else can close like them. The good news is that's not true. You can replace yourself in that key man area and get somebody else to close at, or in some cases, better than you can. And oftentimes they could be a non-attorney so that we can actually maximize the result without having to feel like we have to give up a piece to an attorney who would do this. And then finally, it's the marketing area. And a lot of you have become the face of your firm. Now, I want to be clear. In the beginning, that's actually very, very important, and it's a unique competitive advantage, and building your own personal brand is an important part of the growth process. And until you get to that like $3 million in EBITDA mark, I would suspect you're still going to do that. And when you do that and you start to transition over to getting yourself out of that role and reducing your key man risk, you're going to want to start to replace yourself in the ads. Now, that takes time, it takes a strategy, but it can be done. So in 3 fundamental areas, there is this key man risk, and you have to strategically work to get yourself out of all those areas for you to maximize your value. If you're still in any one of those areas, you're going to decrease your multiple and fundamentally decrease your value.
Exactly. And so that's key man risk. So it's trying to figure out how to ultimately move out of that key man risk over time. The second one is single channel risk. And so what single channel risk, so I want to be clear about single channel risk. Single channel is meaning you've got one stream of attracting new clients. You've got one marketing source, one way, whether that's referrals, whether it's direct mail, you've got one path. And you've got one path to attract new clients. And to be clear, When you're growing, especially to your first $1 million in revenue for your law firm, it's okay to have one single channel, because that one single channel, that means you're able to focus in and optimize it. And then once you start to get past that, I mean, we'll define what that looks like. I would say $1 million a month. But once you start to scale past that number, well, now you need to start diversifying your marketing streams. So now you need to start looking at more than just one single channel, because as a potential buyer, if for some reason that channel dried up, that means your business dries up effectively. And that's nerve-wracking for a potential acquirer.
Yeah, so to plus one on that, I would tell you that my advice for many years was good, but maybe a little misplaced. So I've always taught law firm owners that they should have 3 primary lead sources. And I believe that's true. But one of the challenges is, I think law firm owners heard me say that, and they fell in love with the idea of finding new lead sources. And they don't just have 3, they have 4, they have 5, they have 6. And the reality is they're not getting focused on any one of them. So 2 things can be simultaneously true. Like, the way that you build your law firm to the level that you want to build to grow revenue and grow EBITDA is to hyper-focus on a highly flexible lead source that you can continue to add spend to or investment to and get business out of. Simultaneously, if you rely on a single source and you don't diversify at some point, you've put the firm at risk. So A, yes, you can grow your firm very large indeed on a single source. And B, if you're going to exit your firm, you're going to need to develop a plan to diversify that risk, or the person on the other side of the buyers is going to see that as a risk and is going to fundamentally lower their multiple so that they can lower their overall risk in the deal.
It's exactly true. And then we've got a couple others left to determine the subtractors or detractors on this. One of those is market risk. And market risk, or TAM, total attainable market, that is your actual available market. So most law firms are geolocal. So you're constrained to your local market, and then of that, it comes down to obviously your attainable market in whatever your practice area is, right? So that's like the size of your market. So for most law firms with a single location, your market risk is actually high usually, because you've got one single location in one geographical location. And that's not a bad thing. It doesn't mean go expand and open a bunch of offices. That's not what that means. But as you do continue to grow and you maximize the location, it's figuring out how can you now replicate all of the systems, processes, and business you've got in place there and take that to another location, whether it's another city in the state, whether it's another part of the city, whatever it may be. But that's going to determine whether or not you've got a market risk as of right now. Rich, would you agree with that?
Yeah, 100%. Again, this is that double-edged sword scenario. So when you're getting started, and when I say getting started, even if you're at $1 million or $2 million or $3 million, one of the ways for you to grow your business large, even if you say, I'm in a small town, is to hyper-focus on a single niched practice area. Like if you're a business transactional law firm and you're only going to do business with ice cream shops, I'm not sure that's the right example, but you get my point. Like you're going to hyper-niche on that particular practice area and that particular demographic in that practice area. And if you go, well, I'm a family law attorney, but I'm only going to deal with, moms that have 3 kids and drive white minivans, and I'm not going to take anybody else. Now, it's a little crazy, but like that would be a super highly niche scenario. Or maybe said differently, I'm only going to focus on nurses. So I'm going to be the divorce law firm for nurses. Well, that's actually a great way to niche, right? But if you do that, you're going to really cap your growth. So in the beginning, that's a fast way for you to grow a market. But at the end, if you want to scale your business and you want to be able to sell your business at an enterprise value or succeed your business to somebody else, you'll need to expand your horizons to give them more possible market share. So early days, good idea. Like when I say early days, you could build your firm to multiple millions of dollars in a single small niche, assuming it's not a ridiculously small niche, even out of a small town. We've got firms that have built out of little towns, multi-million-dollar firms because they hyper-niched in a practice area. And you can do that. But over time, you're going to need to expand that niche and that market size if you're going to want to attract any type of enterprise value. Or if you want to maximize the value you can sell your firm for.
Yeah, and that brings us to our final value detractor, subtractor here, and that is data risk. Data risk is another one that's very common among many businesses, but certainly law firms. You know, does your firm operate off of like a Google empire, right? Is your firm just spread across Google, or is all of your data very systematic? It's in one place. You can easily attain it and determine exactly what your numbers are, exactly when you need it, and you've got a system for that. And so this will determine, once again, whether or not this is something that detracts from the value of the business, or in some cases actually reduces risk if you don't have data risk, right? If you do have a very systematic approach to your data. Rich, would you agree?
Yeah, look, so one of the third business that I bought growing up, the guy literally had all of his data in filing cabinets, right? And so that maybe sounds like a bad news. First of all, this was in the early 2000s. And so, computers were there, but they weren't what they are today. And so but I could prove all of that data existed. I could go through the filing cabinets with the files and I could prove everything was there. And so it wasn't the best data, but it was still good data, which brings me to my point. So as long as your data is somewhere that you can point to, and if somebody asks you a question, you can quickly access the information, that's good. Now, the better your data source is and the less scatterbrained it is and the more digitized it is all in one location or in a curated manner that somebody can easily ask questions of the data and get answers, the more your valuation goes up. It gives the business owner that's buying the business or the investor that's buying the business the confidence that you have your act together and that you know how you've built this business and it's not just fly by night. So if you go to try to sell your business and you don't have your data together, your business will not be worth as much. If you were to hire a business broker, one of the first things business brokers do is put together a portfolio of your business by going and harvesting the data, which means they might be going in like adding up receipts or adding up client work, but from your filing cabinets to put it into a comprehensive portfolio to present to somebody so that it looks like it's clean. Now, the problem is if after they visit with the business broker and they see this clean data, if they get into your business and they realize you're working out of like banker boxes worth of information and they have to hunt through things to find the truth, your business valuation is going to go down. So the better you have access to your data, the more you can ask questions of your data and get good quality answers, the more likely your business valuation was going to go up. And the larger your business, the larger your concern, when you get to that $3 million plus EBITDA and you want to sell your practice to a real concern who's going to pay you a real multiple, that concern is going to be more sophisticated and they're going to want to know that your data can easily migrate over to their systems and they're not going to have to do things manually. Otherwise, your valuation will go down.
All right, so look, so we went through like the formula here, right? We went through the importance of revenue, we went through the importance of EBITDA, and then what your value attractors are and what your value detractors are. And all of these things either increase the multiple or decrease the multiple on the value of your business. So look, if you want to get hyper focused and hyper clear on what that does look like for you, you can head over to thelawfirmsecret.com. We're happy to walk through that and have a conversation about it. But for today, we wanted you to walk out of here knowing, A, getting clear on your numbers, B, identifying what some of your attractors and detractors are for the firm, so that way you know, like, what levers can you pull to increase the value and increase the multiple or to reduce the risk on your firm. And if you found this valuable, A, make sure you go ahead and hit that like button, let us know down in the comments, and then hit that subscribe or follow button depending on where you're listening or watching. But we appreciate it. Rich, anything you want to add?
No, hey, law firm owners, wherever you are, if you're new to owning a business, you should be thinking about what your goal is. Is your goal someday to exit it? Do you just want a cash business? And in either case, you should understand what your plan is to build your practice going forward. Should it be, high cash, low tax liability, or should it be high EBITDA, high owner's benefit to build high enterprise value you should always be thinking about this idea of your LTV versus your CAC, and everything else we've discussed is super important. If you're at the other end of the extreme and you want to learn how to sell your practice, and you want to learn how to build the systems in your law firm, the only advice I give is just give yourself enough runway, right? It's not going to happen overnight. You got to put in place a plan to fix these things, and then it needs time to show that growth so that you could build valuations, because these buyers buy with historical data. And so if your historical data is crap and then you make these changes and things are good, you won't get the maximum value until you show things are good for an extended period of time, say 3 to 5 years. So you need to keep this in mind as you're planning, that to maximize your value, you're going to have to get this done fairly quickly, and then you're going to have to hold and continue to grow in order to exit in a position you want to exit in. But I know it's possible. We've done it several times with several firms, and I know the market is changing and getting more and more ripe for acquisition. So I'm excited to watch you grow your firm and exit the way you want to exit.
And look, as we're talking through all of this, and you're trying to figure out and sit here and say, okay, I'm tracking with you, but I'm trying to figure out the value of my firm. We're obviously going to talk through it, but if you want to get laser guided focus on exactly what the value of your firm looks like today, you can go to thelawfirmsecret.com, and we're happy to kind of walk that through with you, so that way you could get some clarity on what that looks like.